We're talking compensation packages, and what typically comes to mind with individuals when you talk about compensation is salary. And please know that there are so many other things that should be included when you present this information to an employee. And that's what we're going to discuss in this video. Compensation packages should include the following. Besides salary, is there a potential for overtime? Can this employee make more financially than just a salary? The employer contribution to group health insurance. The employer contribution to short and long-term disability. Will the employer be making a contribution to some sort of savings or retirement fund on behalf of the employee? Paid holiday. And as it relates to diversity and inclusion, ask the employee, is there any particular or special holiday that is important to him or her? PTO, will that be paid? Will there be a signing bonus? Is there tuition assistance? How about a paid cell phone bill or car allowance? And the goal of all of this is to allow the applicant the ability to fully evaluate the full value of what you as the employer is offering. There are all kinds of bonuses. There's retention bonuses, there are spot bonuses, there are annual bonuses, there are holiday bonuses. This should all be included in a compensation package. Company shares. Do you offer profit sharing? Do you offer memberships or other perks? Do you offer payment for different types of memberships? Gym memberships come to mind. Are there flex hours? Will there be flexibility whereas the employee can work from home on occasion? Are there opportunities for advancement within your company? Are there any company-specific factors like a unique company culture, a unique work environment, or some unique promotional practice that your company offers? Don't be afraid to ask applicants, what are you looking for in a compensation package? As you present a compensation package to a job applicant, be sure to take time to discuss the total compensation package over the phone with that applicant. And if possible, note to the applicant that it may be possible that you can tailor that compensation package to that individual's needs. Allow the applicant time to digest the information. With that being said, know when to end negotiations. No matter how great this applicant may be for your company, no matter how perfectly this applicant fits in your plans, no matter whether they're future plans or what have you, keep in mind your company's budget. If you can't meet the applicant's compensation requirements, it's time to move on. Let the applicant know that your compensation package is no longer negotiable and move on to the next best qualified applicant. How do employers pay for benefits like PTO and vacation? I would like to thank YouTuber Religion Free for submitting the following question. Hello, how do employers budget to pay PTO, holiday, or vacation? Proactive companies budget in advance for employee compensation. That includes things like employee salaries, employer taxes, bonuses, 401k, unemployment insurance, federal, state, local taxes, depending on where your business resides, on and on and on. Employment compensation is typically set aside in a company payroll account. I advise companies to set aside as much money as possible in their company payroll account. Once employment compensation is set aside, your company will tap into that payroll account for payroll plus any covered paid absences, including PTO, vacation, and holiday pay. Other major considerations should include lost productivity. For example, did you cross-train employees to perform the work of the vacationing employee? Will you, the business owner, stay later to perform the vacationing employee's work? Lost profitability. When you hire an employee, that employee's purpose is to help make the company money. Each employee hired should be able to earn his or her compensation plus overhead and profit for the company. Employees on vacation do not earn profit for the company, so you must create a strategy as to how you will recoup this loss. When the employee is gone, for whatever reason, your company loses money unless you plan ahead. It may be a good idea for your company's internal financial and HR departments to establish written policies and processes as to how paid time off and payroll are managed so both departments can smoothly work together. Gross revenue versus payroll. We're talking formulas now. Let's get into it. So there's some formulas that are out there that all business owners should know, and it will give you a benchmark as it relates to the results of that formula. This particular formula will help you determine if you have too many employees as it relates to your gross revenue. It's called gross revenue versus payroll. And I'm sure this formula has all kinds of different names. For our purposes, we're going to call it bleh. But for our video, we're going to call it gross revenue versus payroll. And it goes something like this. Total payroll divided by gross revenue and convert it into percentage. Here's an example. If your company payroll totals $100,000 and your gross revenue totals $500,000, that will give you 0.2% or 20%. And when you're talking about payroll, please include things like insurance, bonuses, and don't forget owner draws or owner salary. The gross revenue versus payroll number can fluctuate, and it depends on the industry. For example, if your company is highly automated, your gross revenue to payroll number will be a small one. If your business is service oriented, you will have a higher number. There are some industries where payroll is the primary cost as it relates to producing the product, and your number could be as high as 50% while still having a profit. For the most part, payroll expenses fall between 15 to 30% of gross revenue, and that's a safe zone for most businesses. Again, remember the formula, gross revenue versus payroll. This formula is not an end-all for businesses, but what it is a benchmark. So use this information as a benchmark to help your company decide if it has too many employees versus gross revenue. Is your company liable if the payroll company you hire does not file or pay any of your company's taxes? I received a comment on one of my YouTube videos from a business owner. I am an independent contractor in Oregon and I am being audited for state income. There are a lot of different reasons in the letter, but the biggest cause for concern is that my payroll company did not file my laborers' 1099s, and now Oregon State is trying to put those monies on me. Can I do anything about this? The short answer, no. I've done several short videos on this topic stating that your company is liable. I'm going to spend a little time on this subject because I do get this often where a company will contact me because they're being audited, and the answer has not changed. But I'm going to give you some tips on how you can protect yourself when using these types of companies to help with your payroll taxes and any other documents that they are required to send out on your behalf. The general rule with the IRS and most states, if not all states, if you hire a company to help you with filing your W-2s, filing your 1099s, filing your income tax statements, and being responsible for submitting the payments on your behalf. And the company that you hire doesn't pay the taxes for whatever reason, the IRS doesn't care. Your company will be held liable for any money that you were supposed to pay. Not only that, if your 1099s, as with this person, if the money is not collected from those subcontractors, your company will also be on the hook for those taxes. They're not going to go after the subcontractors that you were supposed to submit 1099s. The buck stops with you, and they're going to come after you for that money. So you're going to have to pay those taxes that your subcontractors didn't pay. You're going to have to pay the taxes that any employees didn't pay if your W-2s were not submitted. You're going to have to pay interest and penalties on that money. So please keep in mind, when you hire these companies, the buck ultimately stops with you. And while I'm on the subject, that also includes wage garnishments. Let's say your company has a court order, it came in the mail, and you are responsible as a company to pay wage garnishments for an employee that works at your company. If you ignore those types of court orders and your company does not submit the payments on those wage garnishments for that employee, at some point, the court is going to come after your company for the full amount of that wage garnishment. Now, here are my suggestions on what your company should do if you elect to hire a payroll company to pay your company's taxes and file its documents. My clients depend on me to file their W-2s, their 1099s, and all of those types of documents, and in some cases, pay the taxes. What you can request as a business owner from any entity that's providing those services, you want to ask for proof that that work has been done. And in my case, when I use the service, I chose to file my clients' taxes and W-2s. That company sends me a confirmation email. And let me show you how that looks on my end. I receive proof from the entity I use that the recipient copies of the tax forms I submitted have been printed and mailed. I can then take this information and send it to my client as proof that the work had been done. Not only that, the service I use also sends me another email. I receive an email from the service I use that shows that the IRS has accepted my electronic filings. So this is something that you as a business owner can request from the entity you choose as proof that they were able to complete that task. Okay, Nina, well, I didn't do any of that, and I'm now being audited by the state or whatever entity is auditing you. Is there anything you can do? There's only one thing I can think of off the top of my head with regard to what can be done in this situation. Keep in mind, I'm not an attorney, but I do read a lot of contracts on behalf of my clients. Within the contract you sign for any type of payroll entity, there may be some type of clause. And that clause can say, we're not liable if we make a mistake. It could say that if we did make a mistake, we will pay any penalties and interest, or we may pay any penalties or interest if it is proven that the mistake was our fault. The best thing you can do in this situation is read the agreement that you signed to see what liability that payroll entity will be willing to accept. At the end of the day, when you hire anyone to do anything on behalf of your company, documented proof from a third-party entity is the best way you can protect your company and ensure that the work has been done. Also, a lot of these payroll companies have reports and they have documents that they send you as proof that they've done their part of the job. So if you're not getting any type of information from the payroll entity that you hire, that's a red flag. And that's when you have to stop and start asking questions to make sure you've performed your due diligence as a leader, as a business owner, to make sure that the tasks have been completed. You have an employee who has habitually arrived late to work for the past year. 10 minutes here, 15 minutes there. Is this a big deal? Some business owners don't realize how big a deal this can be. I'm going to start out by saying that this video is meant to be a very basic, simplistic look at how late employees can lose money for your business. All companies experience late employees. Sometimes being late can't be helped. But do you know how much a late employee actually costs your business quarterly, annually? A habitually late employee can cost a small company thousands of dollars, while medium, larger employers can lose a lot more. Well, Nina, why do I want to know this? Okay, let's say you have an employee who is asking you for a raise, but the employee is excessively tardy. With this knowledge, you will be able to quantify in dollars and cents how much the company has lost on the employee due to their habitual tardiness, and hopefully deny any requests for a raise. Dollars and cents is a language we can all understand. Excessive tardiness can also create disgruntled employees. This in turn can lead to employees whispering about the excessive tardiness of the other employee, or employees losing focus on their work, delaying meetings for late employees, and other scenarios. Well, guess what? Over time, this is a cumulative loss of productivity. It can add up to serious dollars and cents, all because a single employee had a habitual tardiness problem. Before I go any further, there will be some business owners that say, if the employee makes up the time, should that be okay? And here's my opinion on this, and this is my short version. Perhaps in a few cases, but not in most. I'd like to know what you have to say on this. So please leave your comments or thoughts about employees making up time in the comment section. I'm sure there is a formal collegiate formula to calculate the how much a late employee costs the company, but I don't use that. I use basic math and common sense to get my number. Here we go. Let's say employee X makes $52,000 annually. Divide this into a bi-weekly payroll, or 26 weeks, to get a $2,000 paycheck every 2 weeks. We need to go further. Do the math to break this down to $25 hourly, and the further breakdown of the hourly salary calculates to roughly 41 cents a minute. Breaking the salary down by minute is the key to calculating lost productivity. If employee X is late 15 minutes every day, this will cost your company $6.15 per day, or $30.75 a week. Multiply that $30.75 by 4, that's $123 each month. Now multiply that by 12 months. You get $1,476 annually. This number calculates losses for payroll and doesn't take into account other areas where tardiness could cost your company money. Let's talk about vacation time. Keep in mind that if an employee arrives to work late for 10 minutes every day, they will have been late the equivalent of about a week's paid vacation over the course of a year. Let's talk disruptive workflow. What happens when the tardy employee arrives late for meetings? The late employee robs everyone of their time by explaining why he or she was late. When someone is late for work, they create an unnecessary flurry of rushing and activity that distracts other employees who have already settled down and started working. I highly recommend keeping a complete breakdown of each employee's salary in your employee's personnel file, so you will be able to quickly calculate this information as needed. There are some managers and business owners that may say this is a form of micromanagement. I welcome all of your comments on this subject. For those business owners who can't afford to lose thousands of dollars on late employees, please use this information to help you make employment decisions like promotions, employee evaluations, raises, and terminations. Cost control involves making efforts to reduce and control business expenses to increase profits. As the business operations manager of a small business, this would be on a company-wide basis. A business operations manager at a small business would provide oversight on everything from purchasing paper clips, office furniture, to toner ink. An astute business operations manager would have checks and balances in place for those outside vendors working on company projects. So why is this important? Well, there's three reasons that come to mind. One is to keep company projects on track financially. Two, controlling project costs. And three, of course, ensuring higher company profits. Some of the areas I personally like to watch when I am controlling costs includes internal labor, i.e. employees. Another area I like to watch are those little areas like employee mileage, printing costs as it relates to printing additional reports for a project. When I worked at an engineering firm, part of the deliverables included 4 or 5 copies of environmental reports, and those things could get about 70 to 80 pages long. There's also additional employee time as it relates to getting those deliverables together. Cost variances. This means the difference between the actual cost of the project versus the established budget. Return on investment. Was the job profitable for the company? How profitable was the project in comparison to the amount of money invested in the project? Some of the ways I've learned how to control company costs include getting a full understanding of what is involved as it relates to completing that company's project, understanding the budget, setting up roadblocks that will allow me to monitor all expenses. And one method that comes to mind, one of my favorite methods, is the use of purchase orders prior to committing to that vendor. And finally, educating your employees as it relates to effective time management. Remember that any project going past the deadline requires more labor and possible other expenses to complete the project, and that reduces the profitability of that job. Also, something to keep in mind, as a business operations manager, there are many times where you are not billable to that project. So that means when you are not billable to the project, you should be doing your best to save the company money and increase profitability. Are you a business operations manager responsible for your company's finances? Do this on your first day. Create a copy of the company's financial file on day 1. Well, Nina, why? Short version, you'll have a starting point in case you screw something up. Also, if there was something wrong with the company's financial software file before you got there, you will have proof that this, whatever it was something that happened before you started. Get copies of all the current bill statements for the fiscal year you are responsible for. As a business operations manager who is responsible for company finances, on your first day, you will want to review all the bill statements for the first fiscal year that you're responsible for. This includes those bank credit card statements and lines of credit. Review the section of any payment agreement that the company has with a vendor. Look at that area that specifically outlines the payment terms. Something that comes to mind quickly is a company auto loan, office rent agreements, office mortgage documents. Reviewing these bills on your first day as a business operations manager who's responsible for company finances is important. You'll have an understanding of the company's operating costs. It also demonstrates proactiveness. You'll be able to verify that all of those expenses are in the company's financial software file. And let's think ahead a little bit more as a business operations manager. Was the company ready for tax time? And you can never plan too early. On your first day, don't forget to request the online access information, those usernames and passwords for the company's online bill paying account. You'll be able to not only study prior payment patterns that prior employees made on the company's behalf, you'll also be able to note if there are any discounts for early payments. Review agreements between the company and its clients. Doing this will help you understand as a business operations manager how the company makes money. And in the future, you should be able to determine if the company is missing areas where they should be invoicing clients. Keep in mind as a business operations manager, and this is a generalized assumption, you are not 100% billable to any client. You are considered overhead. So the way a business operations manager, again, this is my opinion, earns their keep is 1, you're going to find places where the company can save money, and 2, you're going to find missing areas where the company should have been invoicing clients. Pull business financial profit loss balance sheets, accounts receivable and accounts payable. As a business operations manager who is responsible for company finances, no one is going to tell you, hey, you need to review the company's financials. That's where your level of expertise comes in. That business owner is going to be expecting you to produce 100% accurate corporate financials. And it'll be your job to inform the company about any losses, any big profits. Double check the classification of the expenses. And also alert the company owners if you see any patterns, if you determine if the company is fiscally sound or if you see any troubling financial patterns. If there are any inaccuracies in the company financials, you as the business operations manager who is responsible for company finances will be expected to make those corrections. And keep in mind, the business owner does not want to hear about any opened-end problems as it relates to company finances. Create your own internal report outlining any issues you see and how you're going to resolve those problems. And that's how you as a business operations manager handle those companies' finances like a boss. If part of your job as a business operations manager involves reviewing and approving job estimates, here are some areas you don't want to miss. It goes without saying that a business operations manager should understand how the company makes a profit, and you should also understand how the employees use different services and tools to help that company reach those profit goals. Understand the scope of the project. What's the end objective? Is it to produce a book? Is it to produce a wheel? Or is it to make a commercial? Know what to look for when it comes to including labor and materials used to complete that project, whether it's paper or mileage costs. Be sure to account for all of those little miscellaneous items, because those, and it may seem trivial at the beginning, but those can add up quickly. Let's talk briefly about internal meetings related to a project. If your company regularly holds meetings specifically for a project, and let's say there are 5 employees in a 1-hour meeting, and each employee makes $20 an hour, you're looking at $100 being spent on a project. And keep in mind, that does not include markup. And that brings me to the next topic. Include the company's markup on all labor and materials related to completing that project. This is typically where I will find errors on estimates, where the project manager forgot to include the company's profit, the markup. This following example is for college students who watch my videos. Your company has an established markup of 20%. The materials needed for the job cost $50. You're going to invoice the client $60. This includes the cost of the labor plus the cost of markup or company's profit. When you're reviewing a job estimate, you must think about what is not included as part of the scope of work. And here's an example. Any additional services or materials must be approved in writing by the client. Travel time must be billed to the client prior to incurring the expense. There are 3 printed reports as part of the deliverables. Any additional printed reports will cost $125 per report. Understanding what is not included in the scope of work will help you not only reduce the chances of scope creep, it will show the client that there are additional costs that they would need to incur if they want these additional items. And don't forget those administrative costs. We're talking about the bookkeeper who has to create the invoice, the administrative assistant who has to create the proposal, who has to create the contract. Those types of employees who are typically not billable 100% of the time. If it's part of your job description as a business operations manager, typically your eyes are the last ones to look at that estimate before it goes off to the client for approval and signature. Lowballing estimates can be the difference between your company being profitable or your company losing money on a very regular basis. And also keep in mind, when you lowball estimates, at some point when that company is not profitable, management will be looking for a way to cut costs. And cutting costs means looking at employees like business operations managers who are not billable 100% of the time. Again, since positions like these are not always billable, you must do your part to earn your salary by cutting costs and saving money. Can you afford to hire an employee? Here are some additional costs to consider besides employer taxes: workers' compensation, professional liability, benefits, payroll services. Is it an office employee? Furniture, telephone equipment, computers, indirect costs, recruitment fees, background checks, ads and publication, time spent interviewing, new employee setup, training, and uniform. Many businesses employ a bookkeeper or office manager to enter financial transactions, bank statement entries, payroll entries, and perform other bookkeeping functions on behalf of your company. How many business owners schedule a regular meeting with this key employee to discuss financial matters related to the company? I highly recommend all business owners schedule at the minimum a bi-monthly meeting with the person who takes care of your business bookkeeping and request the following documents. This will give you an overview of the company. Take your time and research each line item. Ask questions when you, for example, review your expenses. Why did your company pay so much in office supplies for this month? How does this amount compare to last month, last year? What are the bank statement charges? Please pull out the bank statement and show me where we were charged this amount. Who is this subcontractor? Where is his or her file so I can review this company information? In QuickBooks, you can review month and year comparison reports to see where your company has a profit or a loss. If the information is properly entered, you can even compare expenses by job to see if money was lost or made. This is a very good feature and should be used with marketing firms. Don't be afraid to challenge the information on the P&L report and ask your bookkeeper questions. This report will give you an overview of who owes your company money, how much, past due dates, payment terms, and more. If you don't remember the job, I recommend requesting a copy of the invoice sent to the customer. Double-check the numbers on the invoice to make sure the customer was billed the proper amount. Here is where you can request the bookkeeper to contact a customer and inquire about payment status for late payers or create strategies to prevent late-paying customers. Maybe request deposits in the future or other billing strategies to maintain positive cash flow. This report shows your outstanding bills. If your books are regularly updated, this report should give you a list of the vendor's name, company information, the amount of the bill, when the bill was due or past due. This is where you can outline your strategy on how to pay your bills. Will you use a business credit card? Will you use a check? If you have multiple bank accounts, which account will you use to pay the bills? Do you need to transfer funds from one bank account to the other? Request a payroll report and review the names of each person on the payroll roster and the amount each person is being paid. Know how many employees you have at your company to determine if the list is accurate. Check to see that employees who are no longer with the company are no longer receiving a paycheck from you. Double check that there are no ghost employees on your payroll. Did you know you can print out a monthly register for each of your bank and/or credit cards? This will allow you to see how checks are written in QuickBooks or whatever financial software you use. Ask questions like this, for example. Who is the payee on this check if you don't remember the vendor? If you want more information written on the check, request that your bookkeeper use the memo area to say what the check was written for, especially if it's a new vendor. For example, furniture assembly or fixing the sink in the break room. Review bank statements, credit card statements, online accounts like PayPal, and other similar accounts with the bookkeeper to ensure all entries are accurate and you, as the business owner, understand each of these expenses. Okay, Nina, what if my bookkeeper puts off the request? Says that the reports are not accurate or he or she can't produce the reports. I recommend you contact a business operations consultant like me and discuss your issue. Chances are a bookkeeper that can't produce accurate reports is a bookkeeper who is either incompetent or is not able to perform the job tasks for whatever reason. The goal of these types of meetings is for you, the business owner, to get to know more about the fiscal end of your company and show employees that you are a hands-on business owner who understands the importance of understanding the financial end of your business. Over time, you should be asking for even more information to help you map out the best financial strategy for your company. So I was reading the news and I ran across this story. An $84 paycheck turned into an $84,000 overpayment. I'm not going to get into the gist of the story. The title speaks for itself. But what I would like to discuss are tips that you can do as a business owner to ensure that you do not overpay employees to the tune of $84,000. I did a video earlier on how to protect your company should you overpay an employee. I'll post that video up here. My first tip is to not get into a hurry and submit payroll. And what I mean by that is don't do payroll on the fly. Don't have your days so tight time-wise to the point where you only have 5 minutes to click a couple of buttons to do payroll, because pretty much that's what payroll is now. You click a couple of buttons and everyone gets paid, and that includes taxes. When I was responsible for payroll at my last position as a business ops manager, I set aside time to do payroll in the morning before anyone arrived to the office, and that meant the owners of the company as well, because I wanted to review the numbers and ensure that all the deductions were correct, to ensure that all the amounts were correct, and that the taxes were paid. No matter what software you use to do payroll or what company you use to do payroll, you get something called a payroll report. And yes, there are some companies that have thousands of employees, and there are some companies that have 1 or 2. I would suggest that this information, that your payroll summary is printed out and someone review the numbers in your payroll report. Review the final numbers, review the gross numbers, and everything in between. The total pay that the employee was supposed to receive was $84.53. 10 made the difference between $84.53 and $84,530. If your payroll setup includes automatic placement of a decimal point, again, this is my 2 cents. This is what I would do if I was in this situation. I would remove that, because that extra 0 took this to a whole new level. It didn't go $843. It went $84,000. Also, if there are some alerts that you can use in your payroll setup to where it says an alert will pop up if an employee is paid over X amount of dollars, that will make you manually stop what you're doing to review that number. And that could have possibly saved this company a lot of headache. It just takes one mistake to lose your confidence and credibility as payroll or business operations manager. Use the information in this video as a guide to help you create your own unique process as it relates to payroll, and more importantly, ensuring that payroll is correct for all employees, no overpayments, no underpayments. I was cruising on Reddit and saw this question. What are your ways to develop a solid understanding of your company's financial situation? I'm going to respond to this question in the realm of a business operations manager. Depending on the job description, a business operations manager may have total and complete access to the company's financial situation. If that's true, I recommend immersion and self-education. For starters, learn how the company's accounting software works. Not necessarily how to perform every single function of the accounting software, but at the minimum, learn how to access it, how to log in, how to turn it on, how to access the reports that you want, how to print the report, and so on. Understand the company's debt. And is your company able to pay those debts? What is the company's profit or loss for any given period? And you don't have to know this right off the top of your head, but you should at least know how and where to find this information. What are the expenses to operate your company? Things like rent, utilities, office supplies, and so on. Pull those financial documents at a minimum on a weekly basis. Review each line item. And again, make the time for self-education. And I can't say this enough. You must understand how your company makes money and how your company spends money. Company financial statements should always be quickly and easily accessible. They should be accurate. They should be up to date. When I say accessible, I mean those financial documents should be accessible from your accounting software. If the financial reports are not up to date, if they appear to be inaccurate, or if the only time you can see a financial statement is from an Excel spreadsheet, I would say that that company has a bigger problem. When you think about company financials, people think of profit and loss and balance sheets. Part of the financials include original bank statements, original loan documents, original contracts. Any document that involves the exchange of money will help you as a business operations manager understand those company financials and how the company makes and spends money. There are at least 6 government entities that can audit your company. Did you know that your business could be inspected, audited, or even rated by various government entities at the local, state, or federal level? Some of this can happen without notice. With the IRS announcement that it intends to increase audits by 50% in 2021, what processes are in place at your company as it relates to audits, inspections, and raids? Let's understand the difference between an audit, an inspection, and a raid. Inspections are simple and straightforward, typically with yes and no responses. The conclusion of an inspection typically creates action items for the company to complete. Audits can be complex and typically follow a process from beginning to end. They can dig into details with questions requiring more than a yes or no. The goal of an audit is to ensure compliance obligations have been met and usually result in recommendations. A raid, however, on your company involves an unannounced visit by law enforcement, purposefully using the element of surprise to arrest individuals and/or find undestroyed evidence. If this happens at your company, I highly recommend contacting your attorney immediately. From a local standpoint, you have fire and building code inspections. Your state can audit you for, among other things, sales tax, business registration, employment issues, and more. This video will focus on 6 government agencies that may have the authority to either audit, inspect, or raid your company. In general, ADA compliance means that your business makes reasonable accommodations to assist people with disabilities. All public serving companies, regardless of size, must comply with Title III of the ADA. Title I is for privately run companies that have 15 or more employees. Depending on the circumstance, ICE can show up at your company unexpected and even raid your business if they have evidence. Employers are not required to answer agents' questions during a raid. ICE agents should leave an inventory of the seized property as well as a list of employees arrested. ICE auditors serve a notice of inspection to the employer and, just like the raid, can be unannounced. If the business owner or manager is not present, you should be able to request the compliance, safety, and health officer to return later or wait for a reasonable amount of time, up to an hour, until the company representative is available. With that being said, unless there is a warrant or imminent danger in plain sight, employers can refuse to consent to any inspection until the selected employer's rep has arrived. The EEOC audit program provides assurances that EEOC programs are working efficiently and effectively. The audit staff members conduct performance and financial audits as well as special reviews and evaluations. Please keep in mind that the Department of Labor can audit employers at any time. The most common reason that triggers an audit is a complaint from an employee. Typically, there is little advance notice with the Department of Labor audit, but your company can request time to get the requested documents. This is a glossed over review of only 6 government entities that can inspect or audit your business. Do your own research. Find out what agencies may be able to inspect your company. For example, if your business sells food, you might get a visit from a health inspector. Know and understand your rights for each type of inspection. Write a process and inform employees what should happen if someone shows up at your business talking about an inspection, audit, or raid. I want to start out by saying that this video is meant to only highlight information on this topic. I've researched the pros and cons about loaning money to employees. It sounds okay in theory. The employee pulls you aside, states their problem, and asks for a loan. Further, they suggest that you, the business owner, can deduct the amount owed from the next paycheck. Sounds easy enough, right? Making a loan to one employee may lead to requests from other employees requesting loans. This can put your company in an awkward situation, saying yes to some and no to others. What if the employee doesn't pay on time? What if they request to negotiate payment terms? Or what if they need more money? What happens when the employee quits? I want to start out by saying that this video is meant to only highlight information on this topic. I've researched the pros and cons about loaning money to employees. It sounds okay in theory. The employee pulls you aside, states their problem, and asks for a loan. Further, they suggest that you, the business owner, can deduct the amount owed from the next paycheck. Sounds easy enough, right? Making a loan to one employee may lead to requests from other employees requesting loans. This can put your company in an awkward situation, saying yes to some and no to others. What if the employee doesn't pay on time? What if they request to negotiate payment terms? Or what if they need more money? What happens when the employee quits? If you don't want to loan an employee money for any reason at any time, I highly recommend adding this policy to your employee handbook. Should an employee ask you to loan him or her money, I would recite the company policy. The problem starts when you say yes to one employee while saying no to the other employee. This may lead to uncomfortable situations at work and possible litigation issues, as in a discrimination lawsuit, and other scenarios that may create a stressful working environment at your company. Different states have different laws related to this subject. Since I am based in Texas, I will focus on the laws here. Should you decide to loan an employee money, I recommend educating yourself on subject matters related to loaning money to employees. Some of those topics involve the Texas Payday Law, or similar laws where you reside, the FSLA, or the Fair Labor Standards Act, primary federal and wage hour laws, wage deduction guidelines within the Texas Workforce Commission, or whatever government entity monitors employment laws where you reside, and possible tax implications. In Texas, no matter what the employee owes your company, a deduction for a loan payment cannot take the employee's salary below the minimum wage for your area. Not only that, if the employee works overtime, you, the employer, cannot deduct the loan repayment using any of the overtime money earned. I advise any business owner who is considering loaning money to employees to review the rules and guidelines established by these two federal entities. Without getting away from the topic of this video, the Texas Payday Law, TPL, deals with, among other issues, how to avoid illegal deductions from employee wages. A deduction from an employee's paycheck to repay a loan must be authorized in writing by the employee in order to be valid under the TPL. It is up to the employer to document the loan in writing. There are a couple of documents recognized by the TPL that the employee would sign to validate this type of wage deduction. In addition, the reason for the loan must be lawful. An example of an unlawful payroll deduction is for a gambling debt. If gambling is illegal in your state and you bet an employee $100 for whatever, and you win, you cannot deduct the $100 from the employee's paycheck, even with all the documents signed for something which violates state and federal law. To charge interest or not to charge interest, that's something else to consider when loaning employees money. Interest charged to an employee's loan may be considered phantom income earned by your company. The FSLA and the Department of Labor, the DOL, are silent when it comes to deducting for these types of fees, and they might consider these fees as normal cost of doing business. I highly recommend consulting with your professional tax advisor for more information. When someone tells you to keep a secret, as sure as the day you were born, they are going to tell someone, and then here comes the snowball effect of everyone now knowing that your company is open for business with regard to loaning money. Guidelines may include maximum amounts, payment terms, interest rate charges, and types of loans. Loaning money in general is a touchy situation. If you choose to loan money to an employee, I strongly recommend that your company outlines formal rules and expectations surrounding that loan. Employers should never loan money or advance wages to an employee without treating the occasion like a bank would. That means securing the employee's written agreement on a separate loan or wage advance document listing all the particulars of the transaction, such as amount loaned or advanced, date of transaction, full name and social security number of the employee, the amount and frequency of repayment installments, and what happens to an unpaid balance remaining when the employee leaves the company. Some deductions are clear and straightforward, while others are complex and restricted. Find out what legal formalities are necessary in Texas or your state to make a valid promissory note, and include such language in the loan or wage advance agreement so that if the employee fails to satisfy the repayment obligations, the company will have the option of taking the ex-employee to civil court. Again, I highly recommend consulting with an employment law attorney who is familiar with both federal laws and the laws where you reside. Finally, consider this story from an actual Texas payday law wage claim that was filed in late 2006. The employer had allowed an employee paid time off for his wife's maternity medical leave and for her appointments, and in addition for spending time with their baby. The employer verbally agreed with the employee that the paid days off would be repaid one day at a time from future paychecks. But when the employee walked off the job soon after the child's birth, the employer deducted the full amount all at once from the final paycheck. Since the deduction agreement was not in writing, the employer lost the Texas payday law wage claim that the claimant filed. The claimant sent the following email to the employer. I know we agreed to you taking the 5 days you paid me for that I didn't work, one paycheck at a time, but I quit before you could take your money back. You are a dumb SH blank blank. The Texas Commission says without my signature, you can say we agreed to this verbally, but you lose since I didn't sign anything. I intentionally left your store open when I quit. Hope someone came in and stole everything in the store. Answer my call so I can tell you what a dumb SH blank blank you are. I now have a new trick with my next job. Take days off, promise to do makeup work, get paid, and then quit. Very sad. How to prevent your company from becoming victim to a scammer. I was cruising on Reddit and I ran across this post. Scammer alert, surgical mask wholesaler. Our company got scammed by Poland, 32,000 euros. They promised a supply of 3M masks. We paid the money. They kept delaying the supply by giving excuses. Now they are not replying and the number on their website is disconnected. Beware. On a personal note, my husband's hobby turned into a global business. We have vendors from all over the world that we deal with, and there are steps that you as a business owner should take if you choose to go global and start dealing with vendors all over the world. Here are some steps that we use in our business to prevent us from being scammed. This is not an all-inclusive list. Use the information in this video as a guide to help your company create its own unique process as it relates to dealing with global vendors. Establish a business process on how to deal with global vendors. In other words, write it down. Write step by step what you or your employees should be doing when you are dealing with vendors outside of the United States. When making global purchases, do businesses with large established companies or individuals or smaller companies that have been vetted. There are companies on eBay, there are companies on Alibaba. There are real people who purchase products and put a customer rating and reviews, and these are things that you should investigate before you decide to use a vendor. If you have a vendor that has negative reviews, if you have a vendor that doesn't have a lot of reviews, these are things you need to consider before you decide to do business with that vendor. Never send money directly to a foreign country. Use PayPal or another similar type of company to where there's a recourse in case you need a refund. I tend to Google the names of companies to see what information I find. Also, I will Google the name of the company and put complaint behind the company's name to see what else comes up. Google, as we know, is not the Bible. It is full of a lot of misinformation in addition to a lot of credible information. Again, you'll have to piece together the information you find to make your own determination if this company is credible. If the company says it's from Poland, or it is established in Russia, or if it's established in whatever country that it says that it's established in, I would think that that website would be in that native language. With the vendors we do use vendors in Poland. We do have many vendors in Russia. We do have a lot of vendors in other different countries. Their websites are in that language, and in the upper right-hand corner is a button called Translate. So it is able to translate the language into English, and we are able to understand the products that we are ordering. And finally, if the item is to be purchased from an ad, take the time to hover your mouse over the link, don't click it, and just see what is that web address. That will also help you to determine if it's from a legitimate source or if it's from a scammer. Again, use these tips as a guide to help you and your company develop its own unique business process for ordering items globally. There are a lot of scams out there, considering all this PPP loan, all of this EIDL money, and then there are stimulus checks coming in to individuals. Please be mindful that the scammers are already on it. They already know that this money is out there and they want to get their cut. And if they can't get their cut through the government, they're going to try to get it through you. If you have any questions, please leave it in the comment section below. Thanks for watching.